Welcome to the high stakes world of modern restaurants, where profit margins are thinner than a mandolin slice. We're talking between 3 and 9%. Picture this: high pressure, thin margins, and almost no room for mistakes. For decades, operators have been obsessed with one metric: food cost percentage, frantically squeezing suppliers or shrinking portions to chase lower numbers. But as emerging research from 2025 and 2026 reveals, this metrics obsessed approach completely misses the mark. The real issue isn't what you're spending, it's the gap between what your recipes say you should spend and what you actually spend. That gap is called food cost variance, and it's where profitability quietly disappears. Here's the twist: the biggest culprit stealing your profits often isn't theft or obvious waste. It's something called phantom variance, driven by broken data. Today, we're diving into this critical framework that shifts focus from simple food costs to precision cost variance, utilizing data integrity and AI to reclaim lost profitability. Let me show you why this changes everything. So here's the million-dollar question that top operators are now asking. When food cost is off, is the kitchen actually leaking product, or is the business leaking truth? This is the food cost variance crisis. Variance is the monetary gap between actual food cost, derived from physical inventory counts and purchases, and theoretical food cost, the perfect world scenario based on standardized recipes and sales data. Why does this matter? Because every percentage point over your theoretical cost is pure profit leaking out the back door. By 2026 benchmarks, quick service must hit 0.5 to 1.5% variance, fast casual 1 to 2%, fine dining 1.5 to 3%. But if you hit 4% variance or higher, you're in the red zone, bleeding tens of thousands of dollars annually. Here's the shocking truth that emerging research reveals: up to 60% of your variance isn't physical loss at all. We're talking about phantom variance. And it's not someone stealing steaks from the walk-in. This is administrative failure. Outdated vendor prices sitting in your system, mismatched units of measure creating mathematical chaos, and yield calculations that treat whole product the same as trimmed, edible portions. Your kitchen might be performing perfectly, but your broken data makes it look like a disaster. Here's the gap the industry is finally confronting. We spent decades optimizing food cost percentage without asking whether the underlying benchmark was even accurate. Traditional wisdom says chase that percentage down, squeeze vendors, shrink portions, count monthly. But this approach is fundamentally flawed for three critical reasons. First, food cost percentage tells you what happened, but not why it happened. It's a blunt instrument in a world that needs surgical precision. Second, most operators compare actual versus theoretical only once a month. By the time you see the variance, the shift changes, the preps and the receiving mistakes are long gone. It's an autopsy, not prevention. And third, here's the kicker: not all variance behaves the way people assume. Positive variance, where actual exceeds theoretical, hurts margins, yes, but negative variance can signal underportioning, broken recipes, or counting errors, which damages guest experience while fooling your dashboard into looking profitable. The real problem is the gap between theory and reality. And that gap isn't being caused by your line cook's overportioning or someone stealing product. It's caused by broken data chains that make your kitchen look bad when they're actually performing fine. No wonder you can't find the leak. You're looking in the wrong place entirely. So we've identified the phantom. Now comes the critical part: how do we eliminate it? The research points to a disciplined, repeatable framework called the Variance Audit, and it's a game changer. This is a shift from counting costs to controlling variance through three systematic phases. Phase 1 is the data scrub, and this is where you roll up your sleeves. You're auditing every recipe card against current invoices to eliminate outdated pricing. You're verifying unit of measure conversions end to end, because buying by the case, counting by the bottle, and portioning by the ounce must reconcile mathematically. And you're conducting real yield tests on your top items, calculating true edible portion costs from as purchased to edible portion. No more guessing. Phase 2 applies the Pareto principle, the 80-20 rule, through ABC inventory analysis. You're focusing like a laser on your A items, the 20% of high value, high volume products that drive 80% of your costs. Premium proteins, top shelf spirits. These get counted weekly, sometimes daily, while everything else moves to automated or periodic tracking. Phase 3 is operational standardization. This is where you build precision into your DNA. Photographic recipe cards, pre-portioned proteins in numbered containers, and staff training that connects their portion control directly to profit sharing and business stability. And tying it all together is modern automation, AI-driven invoice processing, and perpetual inventory synced to your POS. So the system updates continuously, not once a month. This isn't about working harder. It's about building a system that makes profit inevitable. Now we get to the heart of the matter, the paper's most important finding. Our investigation has uncovered the 3 primary data failures driving phantom variance, and they account for up to 60% of your gap. This isn't kitchen incompetence, it's spreadsheet chaos. First, there's outdated vendor pricing. Your recipe card says chicken breast is $3 a pound because that's what it cost when you built the recipe. But your last 3 invoices show it's actually $4.25. Every single sale of that chicken dish is creating phantom variance that makes your kitchen look incompetent when they're actually executing perfectly. Second, unit of measure conflicts. You're buying by the case, receiving in bottles, inventorying in different units, and your recipes call for ounces. If conversions aren't consistent across purchasing, inventory, and recipes, the math breaks quietly and continuously. These tiny errors compound across thousands of transactions into massive variances. Third, yield calculation failures. This is the difference between as-purchased weight and edible portion weight. You're costing recipes based on the whole tenderloin, but 20 to 40% of that product is fat, silver skin, and trim that hits the garbage. If recipes cost trimmed edible portion, but pricing is entered as purchased weight, or vice versa, your theoretical benchmark is structurally wrong from day one. Your butcher isn't wasting product. Your data is lying to you. The shocking truth? These aren't kitchen problems. They're administrative problems, and they're costing you more than any line cook's portion creep ever could. Once the data is clean, we move to the real-world physical leaks, places where actual product or dollars slip away before, during, and after service. The research exposes major vulnerabilities across the entire operation. First, supply chain blind spots. Shorting and substitutions, where suppliers charge for prime grade but deliver choice and nobody physically verifies. Or manual invoice entry errors, where a tired clerk types $50 instead of $30 for a case of tomatoes. And that error multiplies across months of P&L statements. That's why blind receiving is transformative. The receiving team gets purchase orders with quantities but no prices, forcing them to count and verify physically before the invoice is processed. This decouples delivery verification from financial expectations. Inside your 4 walls, operational process leaks show up everywhere. Scoop creep, that seemingly harmless half-ounce extra on every plate that becomes hundreds of pounds of product waste over a month. The solution? Pre-portioning proteins, digital scales at prep stations, and photographic recipe cards that make the standard visible and repeatable. Unrecorded transfers between kitchen and bar distort departmental performance. Lemons and syrups disappear from kitchen usage, making food costs look terrible and bar costs look amazing. The fix is simple: transfer logs or digital tracking. And then there's outright fraud through checkback voids, where food is cooked and served, the guest pays, but the sale is voided and cash is pocketed. The kitchen's cooked food cost remains, but revenue disappears. POS controls, manager overrides, void audit trails, exception reports close this gap. The implication is clear. Variance control isn't one tactic. It's a chain of controls from dock to storeroom to line to POS, each one tightening the feedback loop and moving you toward the green zone. Here's where everything changes. We are witnessing a profound paradigm shift in restaurant cost control. The industry is moving away from accepting 4% variance as just an inevitable cost of doing business. The 2026 mindset is this: stop treating variance like a monthly autopsy and start treating it like an immune system. Always on, detecting issues while they're small and fixable. Best-in-class operators are moving towards zero variance through AI-driven perpetual systems. Imagine invoice processing that's automated. The moment your beef price increases, every recipe containing beef updates automatically across your entire system. Your inventory becomes perpetual, connected directly to your POS, so every time you sell a steak, your beef inventory adjusts in real time, and variance is calculated continuously, not monthly. This isn't science fiction. This is what the top 1% of operators are implementing today. Instead of waiting for month-end panic, operators get intelligent alerts when vendor prices shift, when a unit conversion doesn't reconcile, or when an A item suddenly deviates from expected usage patterns. Benchmarks are tightening across segments, roughly 0.5 to 1.5% for QSR, 1 to 2% for fast casual, and 1.5 to 3% for fine dining. Anything above 4% is increasingly viewed as a red zone indicator, evidence of systemic failure in inventory, production, security, or data integrity. The transformation is cultural, too. The shift is from reactive monthly audits to proactive daily management, from blaming kitchen staff to empowering them with transparent data that shows how their precision directly impacts their compensation and job stability. The best teams review variance weekly or daily for key items, so correction happens during the story, not after it ends. This transforms variance from a historical metric you look back at with regret into a real-time health indicator that guides daily decisions and protects your margins against market volatility, ingredient inflation, and supply chain chaos. The restaurants that survive and thrive in the next 5 years won't be the ones with the best recipes. They'll be the ones who've mastered the precision of their internal operations. Bringing it all together, here's your roadmap to closing the gap and reclaiming profitability. Start today. Don't try to fix everything at once. First, pick your top 10 highest cost items, your A items, the products that drive 80% of your food cost, and treat them like mission-critical assets. Second, do the data scrub. Audit their recipe cards against current invoices to eliminate phantom pricing variance. Verify and reconcile unit of measure conversions end-to-end across purchasing, receiving, inventory, and recipes. Run actual yield tests on your top items so as purchased and edible portion weights are correctly costed. No more guessing. Third, implement blind receiving this week. Your receiving team gets purchase orders with quantities but no prices, forcing physical verification of what you're actually getting before financial approval. This eliminates shorting, substitutions, and invoice entry errors at the source. Fourth, move from monthly to weekly counts on your A items. That shorter feedback loop will change everything. You'll catch scoop creep, unrecorded transfers, and usage spikes while you can still intervene, not a month later when it's too late. Fifth, invest in integration. Connect your POS with perpetual inventory, even if you start with a simple shared spreadsheet. The goal is real-time visibility, not month-end surprises. Sixth, standardize execution. Photographic recipe cards, pre-portioned proteins, digital scales at prep stations, and staff training that makes the connection crystal clear. Precision portioning isn't about policing, it's about profit sharing, bonus potential, and business stability that protects everyone's job. Finally, build a culture of transparency where variance isn't a blame game. It's a shared scoreboard tied to compensation and success. The core takeaway is this: true profitability in the modern restaurant industry won't be won by simply raising menu prices, cutting labor, or squeezing suppliers. It will be won by mastering the precision of your internal operations. The battle for profitability in 2026 is being fought in the gap between theoretical and actual costs. Treat food cost variance as your primary health metric, powered by data integrity and AI-driven automation, and you'll protect your margins against everything the market throws at you: ingredient inflation, labor shortages, supply chain disruptions. The gap between theoretical and actual costs isn't just a number on a report. It's the single most controllable lever for your restaurant's survival and success. Now go close it. Like and subscribe for more helpful video like this, and connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.